too crazy yet here today. What we're going to talk through here for about the next 20 minutes is a presentation that we call the next 25. And this presentation is all about one guy, and it's going to examine this one client. And the thought is that you probably have some people that look and feel a bit like this client. So we're going to talk this morning here about Jeff. Jeff's a 40-year-old guy, and I think fits the profile of somebody that we would all like to work with. 40-year-old guy, married, a couple kids, and he makes a few $100,000 a year. And he's doing what I think we would all agree are some of the right things, right? He is certainly going in the right direction in terms of what he's saving, because he's taking advantage of the things that his employer offers him, the 401k and the HSA, and he knows that he'd like to retire at age 65. So you know, this is a guy who actually has some thoughts and some plans around what he's hoping for going forward. So what we're going to do in the next 20 minutes here is we're going to examine Jeff. We're going to talk more specifically about what Jeff is doing. We are then going to talk about what he's concerned with for the next 25 years. And then we're going to talk about what his plan could be in order to sort of get him over the finish line with this particular strategy. So let's start by getting to know Jeff a little bit better. So what is Jeff doing? Well, let's start by talking about what he's doing and what he can do as a $300,000 a year income earner. The one thing we would all say you should do, right, is have a savings. Well, Jeff did that. He's taking advantage of his 401k because it's easy, right? He never had to do anything particularly challenging or go out of his way to set that up. IRAs are not a great vehicle for a guy like Jeff. His income is too high to contribute and receive a deduction. We know that a Roth IRA is going to stop being something he was eligible for well before his $300,000 of income. We know he's doing an HSA. As we all know, they've increased in popularity a lot over the past decade or so, and he looks at it more as a supplemental retirement vehicle than something for healthcare, but it does serve both purposes. So if Jeff is looking to save more money, that really just leaves him with this bottom one, right? It really just leaves Jeff with a brokerage account to maintain any sort of reasonable interest. And if we look at where he's going to be at 65, we can see that he's probably going to need to save more money to retire on the same income. If he maxes out his 401k between now and then, he'll end up with just over $1.4 million of money there, all of which is pre-tax money, and that'll generate him an after-tax income, at least at today's income tax rates, of about $70,000. He'll have about $250,000 in his HSA. So again, that should be good to help take care of any healthcare concerns. And between him and his wife's Social Security, they'll have about another $60,000 coming in. So some quick math here tells us that if he retires, he's looking at right now, if he does nothing else, a retirement income of $130,000. Now that's not a bad retirement income, but it is if you're making $300,000 and would like to retire on somewhere close to that. So Jeff knows he has to do more, right? He knows that the funding he's doing is great, but it's not enough to get him where he wants to be. He also recognizes that he's the sole income earner for his family. There's a few other things he'd like to do as well. He'd eventually like to get a vacation home. He'd like to be able to help his children pay for college. And he knows he has a family history of Alzheimer's. And not all of these things are going to be the focus of our plan here today, though I'll argue it can cover most of these contingencies. But these are what's on Jeff's mind and what we're trying to find solutions for him going forward. So what do most people in Jeff's position do? Well, most people in this position are going to start saving money in the brokerage account. So if we look at where Jeff is going to save the next $25,000, perhaps a brokerage account is something that will make sense with him. If he saves that $25,000 in the brokerage account and he averages a 7% rate of return, what we see is that it gives him about another $1.5 million at retirement. And I think that's very reasonable for us to expect. And if we look at the after-tax income that would generate for us, it's about another 88 grand. So that takes us now well over the $200,000 mark for his total income and gets him much closer to where he needs to be. And this works, right? This is what a lot of people have done for a long period of time. However, there are some big upsides to it, right? In his brokerage account, he can invest in whatever he wants. He is probably paying some sort of asset management fee to someone like one of you all. And he is in a position where there may be additional taxation based upon things like the turnover in his portfolio and or the dividends from the assets that he's invested in. So, we're kind of taking a best case scenario here. It's likely that he probably is going to pay some taxes along the way as he reallocates or reinvest some of these funds, and his income would be a little bit less. But if we just take it at face value that this is where it's going to be, he's going to get a lot closer to his retirement goal than he was before doing this. So remember, he ends up with about $1.5 million here, and he can generate just under 90 grand of after-tax income. But when we talk about the next 25 years, which is really that bridge between where Jeff is now as a 40-year-old and where he's going to be at retirement, there are some things that are on Jeff's mind. The first thing he's worried about is what exactly will happen with the market, right? We know there's going to be ups and downs. We've certainly ridden that ride this year about as much as we ever have, right? We see a 400-point loss like yesterday, and we don't even bat an eye at it because that's really not that crazy compared to where a lot of the rest of this year has been. So Jeff is concerned about this, and he should be, right? We know there's going to be ups and downs over the next 25 years. We don't necessarily know what there will be, right? And none of us saw this coronavirus thing coming, but we know there's going to be ups and downs. And as advisors and clients, right, we sort of know how to overcome that. The way that we plan around that is we simply don't put all of our eggs in one basket, right? If we look at the returns of all these different asset classes over the past 15 years, we see that a balanced asset allocation is going to sort of keep him in the middle here, right? We're never going to be at the highest point and we're never going to be at the lowest point, but we get a much smoother set of returns. And that is the best strategy that we really have to counter the ups and downs of the market, and pretty much what we all do regardless of what sort of vehicle we're investing in. The other area that Jeff's concerned, though, is taxes. We know that taxes where they are today are historically low compared to where they have been historically. We know if nothing else changes, that on January 1st of 2026, we're going to see higher income tax rates. And depending on where these elections go, as crazy as it is, we're going to have 2 elections before 2026. I'd say it's likely we're going to see it change sooner. Biden has already come out and said he wants to raise taxes on people making $400,000 or more a year. And while Jeff doesn't fit that mold, he's at $300,000. As a 40-year-old making $300,000, I'd say, there's at least some expectation that he might see his income grow. But we know there's going to be higher taxes if nothing happens. And by the way, since that was passed, a lot of things have happened, right? We've seen the national debt increase tremendously due to all of the federal acts to offset COVID at the beginning of this year. We pumped trillions and trillions of dollars into the economy to try and offset the downturn from COVID at the beginning of this year. And ultimately what that has led to is sort of an explosion in our federal deficit, right? It's over $3 trillion this year. And if we look at where that money went, right, that money didn't really directly go to anything that would help a guy like Jeff, right? A lot of this money went to those one-time $1,200 checks, right? Well, at $300,000 a year, Jeff didn't qualify. He made way too much money. A lot of the money went to unemployment assistance, right? Well, Jeff kept his job, right? So he didn't benefit. And while certainly we all benefit from the economy being more stable overall, which was the effect of all of this stimulus, Jeff didn't directly benefit from any of it. But when they look to pay the taxes later on and figure out how we're going to get this deficit and debt under control, I think it's fair to wonder if they're going to raise taxes, and the people who are going to suffer from that the most are going to be the people making the most money. So even though he didn't benefit from it, he's likely to pay on the other end. So how do we offset this tax concern, right? Well, that leads us to Jeff's plan, because if asset allocation was the way that we worry, the way that we try and plan for market risk, well, then asset location is how we plan for this tax risk. Now, we know Jeff is going to have a lot of money in some of these buckets, right? He's going to have a lot of money in this tax later bucket because he's maxing out his 401k and he's maxing out his HSA. He may have some money in that tax now bucket. Certainly his savings will be there. He probably is going to end up with some other funds there through some sort of company programs for somebody making this much. But this tax advantage bucket, there's really only one thing that Jeff can fund that will make any sense for his goals, right? The muni bond portfolio doesn't get him the return he needs to retire the way he wants. And again, he can't contribute to a Roth IRA, which leads us to cash value life insurance as the only option that a guy like Jeff is going to have to fill this bucket and try and make some sense. So if we look at putting $25,000 a year into a VUL, and we assume the same 7% rate of return that we assumed everywhere else, we can see that Jeff will end up with $1,450,000. So if you were to look at that versus the brokerage account, it's important to notice he does end up with a little bit less money in terms of the total amount of money. However, because of the after-tax nature or the never-tax nature, I should say, of the withdrawals and loans from the life insurance, he's actually able to increase his income pretty substantially and generate $102,000 of after-tax income from this variable contract. We can also see that he gets a death benefit alongside of it, right? Jeff needs some coverage for his family. And while that's not really the primary reason that he's going to do this, the fact that he ends up with a couple $1 million of death benefit here is not insignificant. He also has the ability to withdraw from this for things like purchasing that vacation home later on, right? These are not retirement funds. He has the ability to withdraw from this to help his kids pay for college. Again, they're not retirement funds. He doesn't have to wait till he's 59 and a half. And really important for him is we were able to add the benefit access rider, which is our chronic illness rider, to help him address that family concern of Alzheimer's. Now, for you to believe the life insurance makes sense here, you have to understand four things about it. You have to understand the tax advantages, the policy charges, the investment options, and the market return. So let's talk about those things, right? Well, life insurance is built on 5 key tax codes, and this is probably things we all know, but maybe you don't think about in this manner. The 5 codes you see on here define everything we talk about with life insurance, right? Define the MEC rules, define the fact that we can withdraw to basis and then borrow and not owe taxes on that money. They make the death benefit tax-free, and they allow us to accelerate that money in the event of a chronic illness. So these are all things that, again, we sort of implicitly know, but do we pass along to our clients that these are things that are built into the tax code, right? This is not a feature of Prudential life insurance. This is a feature of life insurance, and these tax codes have existed for decades and are built into law. We also have to understand the policy charges, right? Because if you were to suggest that saving some money inside of a life insurance contract is a good option, well, the obvious cost that exists here and wouldn't exist in something like a brokerage account is that cost of the life insurance. And that's going to be the biggest ongoing cost in the contract, and it's a cost that we can change if we want. Now, we never have historically, but it is something that we can change. But if we look at what happens if those were to change, I think you'll find that it's not as concerning as maybe that might sound. If we look at the cash value at 7% in current charges at age 65, this guy has $1,450,000. When he put in $650,000, he ended up with $1,450,000. Fairly good outcome, right? Well, if we were to raise our charges from day one to the most they ever could be and leave them there forever, you'll see that he puts in 650, but he still ends up with $1,089,000, right? So this can't be the worst decision he ever made, right? If he puts in 650 and ends up with just under 1.1, he's still realized a pretty significant return on his money. In fact, he realizes almost the exact same return on his money as he would have if we just kept our charges the same at 5%. And he earned 5% instead of 7%. And even if he earns 5% and went to the maximum charges, right, we can still see he has quite a bit more than he put in. So I would argue here, and if you see that 0% max charges is the only scenario where he has less money than what he puts in, that we should be far more concerned about the investment options inside of these contracts than we should be about the cost of the insurance. Because if this still works at 7% in max charges, then I need to wonder how I'm going to get that 7%, not worry about those maximum charges. So how do we do that, right? Well, we do that using a bunch of different investment options inside of our contract. Now, many of these names you'll see here are brand names, right? You'll see things like Fidelity. You'll see things like JP Morgan. You'll see some of our own Prudential funds and things like American funds. You will also see some boutique asset managers that you may not have heard of, right? You'll see things like a Calvert. You'll see things like a Hotchkiss and Wiley. But we pride ourselves on having a great portfolio of investment options available for our clients. And by the way, Morningstar agrees. If you look at the Morningstar fund ratings of our funds compared to the industry average, you'll see that our funds on average have a much higher percentage of 4-star ratings or better than all of our competition. And important to note is that the competition includes us, right? So we are bringing all of their averages up. Without us, you would see that number be even a little bit lower. So we have the funds available to make these returns something that are realistic for our clients going forward. So we talked about 3 things here today. We got to know Jeff a little bit. We talked about what he was worried about, and we talked about Jeff's plan utilizing overfunded life insurance to supplement that retirement income and why it can make sense. So how can Pru help? Ultimately, we have a team of advanced planning attorneys and consultants that can help you have these conversations and design these contracts. We also have a number of customized client presentations that we can help put these ledgers in order to make this easy and straightforward to understand for the clients, because ultimately that's going to be key to any of these strategies working and getting the client to buy in. We also have the ability to write the larger cases, right? You have the strength and stability of a company like Prudential to write those larger face amounts for our wealthier clients. How can we approach the market? We have a lot of collateral available for you around that. Most importantly, what I would point out is the ones, again, around our fund selection. We have a number of pieces that go into detail on our funds, talk about the team that chooses the funds and how long they've been around. But important to note, Prudential is a top 10 asset manager in terms of assets under management in the world, which is probably not how you think of Pru. So we do take the business of the funds available in our products incredibly seriously. So what can we do with all of this? Well, hopefully you thought of somebody that maybe looks and feels a bit like Jeff, and we'd be happy to help you put together something that could make sense for him. I'd encourage you to share how this works with your centers of influence and see if there aren't some options there that their clients might be able to benefit from that. And ultimately, as the taxes continue will look to rise going forward, I think we're going to see more and more of a market for this type of planning and folks being more and more interested in avoiding those new higher tax brackets potentially in the future. And this might be a strategy to help you find some new clients and maybe expand your market a little bit more. So Peter, that's everything I had for the formal portion of this. Let me turn it back over to you.
Thanks, Chuck. Great insights. And, I think a lot of us have read the David McKnight Power of Zero book, or the Look Before You LIRP type thing, and the power of overfunded life insurance. I think, as you discuss taxes, and we're certainly going to hear from Carly in a few minutes about the impact of taxes and potentially on the estate planning world. Nowhere in the Green Book or in discussions is the build-up within life insurance even considered for taxation or any taxation changes. So the power of life insurance, not only for the death benefits that it can bring, but as an investment vehicle within the wrapper that's tax advantage, definitely great food for thought, and if we're not already discussing, we should be discussing these sorts of things with our clients. I will open it to the floor for any questions at the end of the presentation. So I'm going to hand over to Carly. Carly, if you can share your screen, big green button at the bottom, and then we'll open the floor for questions at the end. But Carly Brooks, she's an associate counsel also in the advanced planning market of a great partner of ours, John Hancock. And Carly, looking forward to hearing from you. So
great, thanks so much, Peter. Yeah, let me get this up and going. Hold on 1 second. Oops, hold on 1 second.
Give Carly a few seconds to get her presentation shared.
Okay.
Just the share
a little
screen
lag
again.
here. You're not seeing it?
No, just you had it up. I think yeah, there we go. Your screen.
Oh, there we
sharing.
go.
There we go. Now we do.
Perfect. Okay, perfect. Great. Thanks so much. Yes, Peter, thank you very much for having me here today. And hi, everyone. Thanks so much for your time. I think that we're going to shift gears a little bit. So I think what Chuck covered, is certainly very timely too. And I think as we have sort of all experienced this year, it's certainly been a very unique year for our clients, in the industry as a whole. And so thinking about all the different ways that life insurance can provide benefits for clients, we just saw Chuck kind of cover a retirement solution that, I think is very timely. I'm going to shift gears and really focus a little bit more on the high net worth space and thinking about gifting opportunities in our current estate planning environment. So as we think about year-end planning and leaning towards the new year, heading into an election, sort of reflecting on all the circumstances this year, we are in very unprecedented times. I think that's been sort of the word of the year, but it certainly is true in the estate planning context as well. So they're really in some ways, I don't think we've seen the level of kind of motivation to plan and timeliness for planning for these high net worth clients to take advantage of the estate planning environment that we're in. So it's definitely, I think, an exciting time to be planning in this space, or at least we think so. So in the time that we have, we'll just walk through. Sorry, my computer's a little laggy here. There we go. So we'll kind of walk through what's our current estate planning environment and the outlook. Won't spend too much time really focusing on where we've been, but what I really want to do is kind of focus on where are we going? So what are the opportunities for gifting? How can we direct conversations with our affluent and high net worth clients? Flexibility has become very important. So even for clients that have the capability to make large gifts, what are some of the roadblocks that we come up against for why they might indicate they don't want to gift? And then as we think about opportunities from a life insurance standpoint, and we'll talk about this a bit, is really thinking about working with, as clients continue to kind of work with their attorneys, we'll talk about how attorneys and the estate planning community are encouraging clients to make gifts, but then how do we as life insurance professionals try to highlight the benefits that life insurance can offer and encourage clients to leverage those gifts in trust to purchase life insurance? So how do we engage clients, and how do we engage their entire planning team as well? So as we said, all the uncertainty we faced this year, it's been a year of sort of unprecedented of occurrences, really. We've had the pandemic, there's been market volatility. The upcoming election has certainly presented a lot of challenges, but also a lot of opportunity, I think. So as we just kind of saw from what Chuck covered, and we've seen this a lot in the clients and conversations we've had, is there really is a renewed focus on protection needs and legacy planning in the high net worth space. So again, as financial professionals, I think that gives us a lot to be excited about. Clients are thinking about their plans, they're thinking about what type of legacy they want to leave to their loved ones and how can they implement those plans and sort of act on them now. So looking at our current environment, I mean, this is probably a refresher for most of you, but as we know, we have the highest estate tax exemptions in history, currently at $11.58 million per person. Clients also have that ability to gift the $15,000 annual exclusion. So encouraging clients to be making use of annual exclusion gifts is continually important. Back in 2012, we did see that portability of the exemptions between spouses was made permanent, but in some contexts, that may not be enough. So we're still seeing trust planning for GST exemption preservation, and in states like Massachusetts, where many of us likely are, efficient estate tax planning with trust we're still seeing that, and that's still timely and important. We've also enjoyed a historically low interest rate environment for some time, and we'll look at that momentarily. But when you sort of unpack everything and put it all together, we have the highest exemptions in history. We've had a low interest rate environment. And so what that means for our high net worth clients is that virtually all planning options are going to be on the table as they start to think about, how do I best structure my plan? But the question that I always ask is, do you think low interest rates and high exemptions are here to stay? And the answer to that is maybe not. So interest rates environment, given how low they are, it's likely interest rates will rise. High exemptions, we already know that unless some tax code is enacted or some tax law is enacted, that in 2026, that exemption is coming. So we know that, I don't know that keeps advancing. So we know that in 2026, the exemption is coming, but it could be coming sooner. So as we head into an election, there's more imminent and immediate uncertainty. So under Biden's proposal, we may see gift and tax exemptions cut in half or lowered in 2021. We could see an increase in the estate tax rate. And so that's why I think many individuals and their families are now being told by their attorneys and CPAs and all their professional advisors to make large gifts by the end of the year and preserve those exemptions. And I've had a few people ask me, do you think attorneys really are acting on this? I mean, it's something that we can sometimes say, but I can tell you from my personal experience and the attorneys that I work with, particularly in the Boston area, is they've indicated they're the busiest they've been since 2012. Clients are willing to act. Attorneys are planning as though tax laws changes may be coming soon. And what I think that means for all of us is a couple of things. One, we're in a really unique and good position to help provide resources and education on combining life insurance with those estate planning solutions. And two, the window of opportunity really is now. So if you want to get your clients to plan before year end, really encourage that we have these conversations now and start to think about what are the solutions. And so we'll talk about some of those solutions today. Typically, they're going to involve either gifts or loans or some other financing technique to a trust. How do we leverage those with life insurance? And then as we're using trust planning, how do we optimize assets and build flexibility into those trusts to encourage clients to gift and feel comfortable gifting? So once it's been decided that a gift to a trust or another estate freeze technique makes sense, how do we educate clients and the planning team on why they should leverage those gifts to purchase life insurance? This kind of goes back to, this was covered in the last presentation a little bit as well, but I would position it that life insurance has three real fundamental benefits. So the death benefit, and just talking about the death benefit here, and not all the living benefits, as we know life insurance offers as well. But the three fundamental benefits of a life insurance death benefit for high net worth clients or for any client are the liquidity it provides, the income tax benefits, and the favorable internal rate of return. So I always kind of position this as, could your client's legacy plans be enhanced by adding an asset that provides an income tax resource of liquidity? Could it be enhanced? In many cases, yes. Additionally, realizing income taxes are likely to rise in the future, affluent clients are likely going to be interested in building a tax favorable yield into their estate plan. And that income tax-free death benefit can be used for a variety of purposes. So I find that even for clients that are very high net worth, very liquid, who might say, why do I need life insurance when I already have liquidity? Yes, I might have to pay estate taxes, but that's okay. I have liquidity to do that. Why else would I want life insurance just from a pure investment standpoint? And what can that death benefit be used for? So things like estate equalization, enhancing the legacy to heirs or protective inheritance, making sure that there's a set dollar amount to pass on, And another really big one right now is you look at income tax changes and what might be happening with that step up in basis, and how can we offset those types of things, or even if we retain the step up in basis, as we know, trust assets and as well as assets like IRAs and 401ks don't receive a step up in basis. So in those cases, the life insurance can provide a lot of flexibility to help offset income taxes on those assets. Once it has been sort of decided to make a gift to a trust, and like I said, attorneys are acting and encouraging clients to make gifts to their trust, it's sort of up to us to help, I think in many of these cases, drive the conversation on why they should then use those gifted assets or that gifted cash to be used for life insurance solutions. And once you combine gifting with life insurance, there's sort of endless opportunities, I think, there in terms of flexibility. But gifting cash to a trust to pay premiums is simplistic, and that's what we typically talk about. But you can get really creative when your clients are willing to use their gift exemptions and make gifts. So we've seen this year exiting different types of financing arrangements that maybe have already been put in place, exiting a premium financing deal earlier. There's a lot of, seed gifts for defective trust if you want to implement more sophisticated, if you will, estate plans. So a lot of options for gifting with life insurance. What types of assets your clients have really will matter. So I think that as you sort of unpack where we can drive these conversations, thinking about what types of assets do the clients have, can they get a discount? Depending on the asset type and the amount transferring, it might be possible to get a lack of marketability or lack of control discount. Could there be an embedded discount? So if we think about the market volatility that we've experienced, while you can't discount things like stocks, when we see downturns in the market, gifting assets that are depressed in value can make sense from a planning perspective. So gifting outright, again, is often very simplistic, but there's a lot of flexibility once you decide sort of how do we take that gift and maximize it from an efficiency. So the first thing, though, that we always talk about, and I always point this out in these conversations, is in our world in advanced markets, and I'm sure for many of you listening, we're so focused on how do we fund the life insurance. Establishing the need is really the first piece of that. And so that's where I think, again, just making sure that you're highlighting that life insurance offers tax-free liquidity. It offers a really favorable internal rate of return, and sort of how it can complement an entire portfolio, I think is really important. And then in some cases, the funding piece of it is secondary and is, can be more simple. So we have to get clients motivated to gift first. So with all the uncertainty that we've faced this year, I found that many clients are hard pressed to do irrevocable, inflexible planning, and particularly with exemptions as high as they are, where there's sort of this: will they go down next year? Will they go down in 2026? We don't know for sure what will happen. So I think that most clients, and even very high net worth clients, would fall into this category. Is how can we create flexibility with those gifts? And so one really simple way to do that that's well founded is through spousal access language. So would you want your spouse to be a beneficiary of your trust so that you have indirect access to those trust assets? And many of you, I'm sure, are familiar with SLAS, but if you're not familiar, essentially how it works is that it's an ILET, so an irrevocable life insurance trust that has special provisions that allows for the non-grantor spouse, in addition to descendants and other beneficiaries, to be a beneficiary of that trust. So the grantor insured creates the ILET, spouse and children will be beneficiaries, and it allows for the spouse to have trust distributions, which allows for indirect access and gives flexibility down the road if there's changing needs, because assets can be accessed by the spouse. So what we'll often see here is the husband will create a SLAT for his wife, and then she'll create one for her husband with slightly different terms. So we need to know that there's enough differences so they're not what we call mirror trust or reciprocal trust. But working with the attorney and the planning team, they'll be able to draft around those reciprocal trust rules. And this is, a very easy way, I think, in many cases, to get just additional flexibility and control. So thinking about the low interest rate environment and other solutions, and this is where a lot of the opportunity comes into play. So we think about gifting a lot, and as we've talked about, I think a lot of estate planning attorneys are encouraging clients to make gifts. But there's a lot of reasons why clients themselves either can't or don't want to make gifts. So their exemption may be used up, or they have it earmarked for something else, so they're not going to make gifts to purchase life insurance in the trust. Maybe they're nervous about irrevocably gifting when there's uncertainty in the world right now. We covered that. Things like spousal access language can help to alleviate some of those concerns, but in many cases that might not be enough. I can't afford to gift that much during my life, or I don't have the assets. That's really something that I think is very interesting and really worth highlighting, because while I think we all wish, sorry, I don't know why that keeps advancing. While I think we all wish, or it'd be fun if we all had clients that were multi-millionaires, 200 million and up. Many clients that we work with, I would say, are probably in that $10 to $20 million range. And if you have clients that are in, call it, $5 to $30 million range, they're likely to face an estate tax, or they will face an estate tax after the sunset, but you're never going to get a client that's worth $20 million to gift their full exemption. It's not realistic. It's not feasible given their total net worth. So for clients like that need to account for and plan for estate taxes, but aren't going to be able to gift away all of that during their life, leveraging interest rates or some other financing strategy can be a really effective way to fund the life insurance need when they're not able to irrevocably gift away those assets. So, and then last but not least, clients that are doing income tax planning and weighing the benefits of receiving in the step up in basis versus the estate tax exemption. For those clients, like I mentioned, appreciated assets that want to retain that income step up in basis and are hesitant to make gifts, funding the life insurance need can help to replace that. So a few solutions here, and we'll walk through these, but for clients that are, again, unwilling or unable to make a gift, financing options can make a lot of sense and can be really a beneficial way to fund the life insurance need. And also, again, thinking about flexibility, what we would call a wait and see loan. That's what I really want to spend the rest of the time today talking about. But wait and see loans is something that we've had a lot of success with this year. And this is basically at a high level saying, implement a loan based on the assets that you have. So you're going to loan cash to your trust at a low interest rate, lock in the loan. The loan's proceeds will fund the life insurance, but you have the option to forgive the loan at any point in time. So we'll walk through that a little bit, but let's look at where we've been from an interest rate environment. So we see that we are at a historically low interest rate. Certainly, historically speaking, we've been in one for a number of years now. Like even going back to January, interest rates were historically speaking quite low. But as you can see back in really April and kind of onward since then, interest rates have really taken a nosedive. So every month we track these on our team, and we can't believe that they haven't ticked upwards. We just got the November rates, and the chart's not up to date, but you can see here, the November short-term rate is the lowest in history. We're still in this low interest rate environment, and really what that means is we're in a very unique time, I think, as we look to implement these different types of financing strategies. So review the rates. One kind of actionable item could be too, is if you've had a client that was considering implementing a financing arrangement, or perhaps already did, maybe we're rerunning those at lower rates. It is possible, depending on the loan terms, to refinance some of these loan arrangements. And so that could be an action item if you have clients that are thinking about either modifying their financing arrangements, or, and that can always open up new opportunities for new insurance needs. So how do we create flexibility? So another option to bring flexibility comes into play again when you have a client who's on the fence about initiating planning, or they want added flexibility and control. So we talked about that with financing techniques in general. Might be a client that's used their exemption or earmarked for something else. And so these are the clients that realize that there's a limited window before 2026 to gift, or maybe they are concerned about what tax law changes even sooner than that could bring. So here we're going to assume, again, that they're going to take advantage of a financing technique. So here we'll just show private financing, what we call private financing, which is really just the grantor is going to make a loan to his or her irrevocable trust. The loan will be set for a number of years. And so based on the number of years, we'll use the AFR rate. So maybe it's the midterm AFR or the long-term AFR rate. And we're going to assume that the trustee of that trust is going to invest that money. So again, we're not disrupting assets under management. The money there is going to need to be invested by the trustee. We're going to assume that the trustee will invest that money, and that will help to service the interest that's going to be due back to the grantor each year, as well as pay for the premiums on a life insurance policy in the trust. So we're using the return on the asset to pay the premiums on the life insurance policy and pay the interest back to the grantor. At the end of the loan term, you'll have a fully paid up life insurance policy owned in the trust. And because we haven't touched that principal, the grantors repaid their principal at that point in time. So they get their money back, which provides a lot of flexibility. They can be repaid sooner if needed, or they can opt to forgive the loan if needed. So there's a lot of flexibility there in terms of if their personal circumstances change or if tax laws change. The life insurance is funded in the trust, but there's flexibility about how we arrange that loan and get the money back to the grantor or not. Where the wait and see technique comes into play is if the grantor says, I don't need to be repaid, you simply rip up the promissory note, note that the note has been forgiven, and file a gift tax return. And now you have the fully funded life insurance policy in the trust, as well as the loan principal that's going to just now, it's an estate freeze technique, essentially. So you're going to have the asset removed from the trust and in a side fund growing for the benefit of the family. So I think it's simple to kind of easiest to show this walking through an example. Here we use the June AFR rate, which was 1.01%. It's slightly higher than that now, but for illustrative purposes, this kind of can walk through the technique. So here we have a client who's 55. We're going to assume that he's going to loan or sell an asset worth $5 million to his trust, and again using a 15-year note, so it's going to be the long-term AFR. We'll assume that the asset in the trust generates annual income at 5%. Is that achievable? I mean, that's kind of where we lean to you. So we can dial those rates based on what the client's financial professionals believe and indicate is reasonable. So here we're assuming 5% annual income, and the trust is going to take that 5% annual income and purchase a John Hancock Protection IUL life insurance policy that will have approximately $13 million death benefit on the grantor's life. And again, we're illustrating premiums for 15 years to mirror the loan terms. And so that's something that, could be customized for the client differently, but typically will mirror the premium stream with the terms of the loan to illustrate these designs. What that is going to do, that 5% is going to do two things. It's going to pay the premium on the life insurance policy of $190,000 a year, as well as the loan interest of $50,500 back to the grantor. So those interest payments back to the grantor can help to provide resources for ongoing income tax liability. So this is structured as a grantor trust, so the grantor is paying income taxes. So the interest payments can help to offset some of those income taxes. And now you have a policy that's put in force today. The grantor has the flexibility to decide when to make a gift. So again, remember, they can wait and see and say, I'll make a gift via the loan forgiveness, or if not, they can be repaid under the loan terms. Either way, the flexibility is really theirs. So seeing this kind of by the numbers, again, you can see that $5 million loan with interest at 1.15%, $50,000 or $50,500 a year. In option one, we are going to show that he's going to make a gift. So in this case, maybe it's before 2026. But again, depending on what happens in the next year or so with the election, could be sooner. So here we'll assume that in year 6, he makes a $5 million gift. And so by ripping up the promissory note, that's treated as a gift. And now all of that trust income will stay in the trust for the beneficiaries. There's no more premium payments due after year 15. So the side fund is not going to be directed at that point to pay premiums and will continue to grow. So by year 31, considering both the death benefit on the policy and the side fund, we're projecting the total net to heirs to be, over $25 million. So a very substantial benefit to heirs, can help to enhance the legacy. The liquidity can help to be used to pay income taxes if they're due at that point in time, or just really kind of infinite options there with what you can do with the death benefit. Alternatively, if tax laws change, he can certainly be repaid in year 15. So maybe the exemption is extended or his financial circumstances change or whatever the case may be, the client under this, because remember, it's just a loan arrangement, they can decide to not forgive the loan and just be repaid. So here, again, we're merely using the return of the asset to pay the premium and interest. So at the end of the 15 years, the principal still exists and can be used to repay the grantor. So now we have a policy in the trust that's projected to require no further premiums. And we've succeeded in getting the clients to put in options and put the policy in place today. But we're not asking them to make any decision about gifting. So really important, we're funding the policy. And then any appreciation on the assets is also removed. And we did all of this without having to use any exemption in that repay the loan example. So I think that this kind of highlights the power of financing first and foremost. So in that repay option, you're getting a $13 million asset that's income tax free, will have a favorable internal rate of return, and is completely liquid without having to use $1 of gifting. That's pretty impactful. And then if you say, okay, if you know what, actually my situation has changed, or tax laws have changed, I can afford to forgive all or part of that note, the total net to heirs then just kind of can grow substantially as you factor in that side fund. But even just under the loan arrangement, we're funding a life insurance need. And I think that, you know, again, is really beneficial for a lot of clients. A lot of opportunities to leverage these low interest rates, and we have the ability to create customized proposals on all of these topics. A lot of these are really going to come down to, again, what types of assets does your client have? So for more liquid clients, private finance loans, like we just covered, are pretty simple. So they're loaning cash to their trust. If you have clients with less liquidity, maybe we're talking about split dollar, using very low economic benefit rates, and using a GRAT that's funded with appreciating property as the rollout. If you have clients with income producing assets, so think things like a closely held family business or real estate, they could sell a portion of that to their trust. A lot of these techniques do take time to set up. So one thing that I kind of always point out is just sort of a practical tip is, if you think your clients could take advantage of the low interest rate environment, you know they have the life insurance need, and you want to show any of these, think about all the steps that have to go into something like a sale. So you have to get the trust drafted, you have to go through all the valuation of the business. It can be or time consuming. So to get the life insurance need and that kind of piece of the puzzle moving, what we'll often see is the clients might gift the first year premium to the trust while they implement one of these other financing techniques going forward. So there's a lot of flexibility with how we design these. Excuse me. In the high net worth space, I've seen a lot of success. The intergenerational loans, that comes up for clients that maybe you have a senior generation of wealth who's maybe not insurable, where they can make loans to a trust where the insurance will be owned on the second generation's life for the benefit of grandchildren. There's so many different ways we can structure these types of arrangements. So how do we engage clients? Who do we approach? As we think about sort of where we're headed from exemptions, I would still say in the high net worth space, or the high net worth clients 10 million and up are the ones that are going to be focused on estate planning. These could be clients that have exemption available, so outright gifting is an option, or if they have little exemption or they're unwilling to make a gift, or like we said, they just simply can't afford to gift all of their exemption, that's where a financing technique can make sense. What assets to look out for? We talked about this a little bit, but depending on the assets your clients have, there's a lot of options. And then sort of next steps of reviewing proposals. I think that these are questions you should ask your clients. So would flexibility like spousal access language help? What type of legacy do you want to leave to your children or your loved ones? Thinking about what are their goals and how can we help achieve those goals by sort of highlighting the benefits that life insurance can offer. Doing things like estate planning reviews. So I know I mentioned reviewing to see if they have a financing arrangement in place and what was the interest rate on that. Could we review those? But reviewing their estate plan, reviewing beneficiary designations, all of those sort of policy review type things right now are very important and can lead to new opportunities. So again, I think that it's a really good time to be having these conversations with clients about gifting and exploring financing in the interest rate environment. So last but not least, why sell John Hancock? As a carrier, we offer a really robust suite of products, both single life as well as second to die products. We have a new second to die accumulation variable product, our ASBUL, which we've seen a lot of good conversations in terms of the estate planning, where a lot of times we're showing second to die policies that can make a lot of sense. Vitality, the Vitality story, as well as our Aspire solution for clients living with diabetes, and our living benefit riders, including our reimbursement long-term care rider and critical illness benefit rider, all really can round out sort of the story for your clients as why they would consider life insurance. I think as a carrier, we've really kind of risen to the occasion in terms of everything with COVID. Prior to COVID, we've had our express track underwriting, but even now, our underwriters, we work to try to make good decisions for our clients and do so quickly. In the large case space as well, this is an area where I think when we think about estate planning and kind of us as a carrier, not only do I think that our products really fit well with the sort of high net worth estate planning solutions, but when you think about our generous capacity limits and our case management team that's available to help out on those large case opportunities, that I think can be really meaningful, as well as what we can offer in advanced markets here. So we have our John Hancock proprietary solution software that allows for us to create customized proposals on a variety of advanced markets concepts, including many of these estate planning concepts. We're always happy on the attorney side and with our advanced markets consultants to get on the phone with you, with any of the other advisors that you work with, the client's attorneys, things like that, and help to walk through case consultation. And then we just have an abundance of different marketing resources and other educational materials that can be really helpful in this space. So hopefully you will be able to reach out to us if you have any questions about any of this. So I will open it back to Peter. I think I probably took my full 20 minutes and then some, so apologies, but hopefully we have some time for questions, and thanks again for having us today. I think this is really good stuff.
Yeah, thank you so much. It's actually, I've heard, these sort of presentations before, seen some of the content, you add some new light and life to it, and I do appreciate it. Before I summarize the entire call, are there any questions from anyone on the line? You can all unmute yourselves individually. All right, so if there's any questions that pop up, please feel free either to put in the chat box or jump in by muting yourself. I just, in terms of the flow, great input, Chuck. Thank you so much in terms of, using the benefits of life insurance while you're living, the build-up, retirement planning, life insurance as an asset class, and leveraging the tax advantages, and then Carly, planning for one's ultimate demise and leveraging what's available under the current tax law. I think all of us realize that there is a closing window, and we should leverage these techniques, absolutely, but life insurance has a role to play both in, the build-up and ultimate liquidity plays. Both products, both companies, all ideas are great. I really do think that if clients aren't taking advantage of it right now, it's probably because people aren't speaking with them. And one of the concepts that Carly spoke about, the wait and see concept, is just it's a no-brainer to me. So, take your money from your left pocket, put it in your right pocket. You can always call it back or give it away later. So I really like those sort of concepts. But we're almost out of time. Any questions from anyone? All right, I don't think there are any questions. Chuck, Carly, both of you, and Ed and Meredith on the call, thank you for your support and your time and your efforts. And we'll all be chatting soon. So I'm going to leave the line open, and those who want to leave, please do. But we'll stay on the call for the next 3 or 4 minutes. Thank you, everyone, for attending.
Thank you.